We're seeing a lot of interest in the dollar pairs right now, a lot of focus on what's happening in the US, more specifically what's going on within the Federal Reserve. Now, the reason for this is because the central bank is talking about tapering. Not only are they talking about tapering, but doing so this year. And doing so at a time when a lot of the economic data that we've seen recently seems to be turning to the downside, and we're heading into a potentially troubling winter period when we could continue to see rising COVID cases and an economic recovery slowing down. So there's a lot of tenseness really in the markets from what we're seeing, because at the same time we are seeing rising levels of inflation. Now, what's interesting about the data that we've seen this week is that inflation actually subsided a little bit. So we came in a little bit lower, still well above the Fed's target, of course, but a little bit lower than markets were expecting, taking a little bit of the pressure out of the situation. And then on the flip side of that, we had more data out today, showed that was actually much better than we were expecting. So retail sales, for example, last month, rather than showing a decline of 0.7%, which is what was expected, we saw a monthly increase of 0.7%. The Philly Fed Manufacturing Index ending a long-standing decline. We've seen month-on-month declines now since March, and it actually bounced back quite strongly with companies more optimistic about the next 6 months. So this very much goes against the trends that we have been seeing more recently in the markets. And what's interesting is that while we did see stock markets, for example, get a little bit of a bump on the back of this, the biggest moves that we actually saw were in the FX space, in the US dollar, on the back of rising US yields, which then hampered gold, which we'll talk about another time. But right now, what we can see is that the dollar is continuing to power higher. And as you can see from this euro dollar chart in front of you, we are seeing the dollar build on the gains which have been coming over the course of the last couple of weeks. Now, what makes today's move a little bit more interesting is the fact that while we have been seeing the dollar gaining over the last couple of weeks, it has been doing so quite gradually. And the reason for this, I think, is one, we're going into a Fed meeting when the data and the Fed speak seem to slightly contradict each other. The data softening, but Fed officials remaining quite hawkish, continuing to talk up the need to taper this year. And I think that was lending itself to a little bit of dollar strength on the cautious side. Also, if you're looking at the chart as well, you can see that actually the moves that we were seeing in the euro dollar pair, for example, moving lower, was actually a bit of a corrective move of the recent trend, which in itself is a corrective move of the longer term trend. But what we've seen on the chart itself is that the euro dollar pair was pulling back, having run into resistance around that 119 level. Now, this was a 38.2% retracement of that longer term downtrend. And it looked as though we were going to see a larger retracement than that. We'd just recently broken out of that descending channel, which it had traded in for quite some time. So just a 38.2% retracement in this case would be extremely shallow. So what we were looking at really was those fib levels to the downside, so covering the August lows to the September peak, and the 1561.8 fib levels falling around where the price was trading just below 118. And we're trading really at the bottom end of that at this point because of the surge that we've seen in the dollar today. So that's going to give us a big indication as to where we could potentially see the next path of travel. If we move below that 761.8 fib level and continue to trend lower on the back of this stronger US data, then that may suggest that that's it as far as the retracement back to 119 is concerned. It would have been a lot more interesting to see a move back towards 120, which falls around the 200-day simple moving average and the 1561.8 fib of that longer term move. But potentially we have seen just a shallow corrective move and the dollar's continuing to gather pace. Now, ultimately, this all depends on what we will get from the Federal Reserve next week. But the signs suggest that the market is adopting a relatively hawkish stance, and the US data that we've seen so far today has only really accelerated the move that we are seeing in the US dollar. And I think this is going to be the one to watch over the course of the next week, because if the market is buying into a hawkish position from a Federal Reserve perspective, then the actual announcement itself could be really interesting. If the Fed adopts a more dovish stance, then we could see quite a significant reversal in fortune. Quite often we'll see traders sit on the fence really ahead of these decisions, and it looked as though that's what we were seeing. But if we continue to see these moves that we're seeing today built upon, then we could go into this Fed meeting with a slightly more dovish Fed being a big catalyst for some big moves across these markets. So I really think this is going to be one to watch over the course of the next week, with more data to come. We don't have any Fed speak. We are in the blackout period ahead of the meeting next Wednesday. So I think there's going to be a lot of focus now on the US dollar, on US yields, as we await to find out if the Fed is going to continue to persevere with its determination really to taper later this year, or whether it's going to view the downside risks from COVID, the downside risks in terms of the economic data, and that little bit of room it was given from the inflation reading this week, and decide to take a bit of a more patient approach.